I'm Josh Duvall, certified financial planner, registered tax preparer from Joshua Duvall Financial Planning and Accounting. And what I wanted to talk to you today quickly was about kind of how to manage reaction to a stock market that's sliding, what to do when the stock market slides. So here we are in the month of February 2022, after a really great kind of last 2 years of returns in the S&P 500 and kind of across equity markets. What we're starting to see is a little bit of challenge, some headwinds to the markets to start the year, down between somewhere 4.5% to 5.5%, kind of depending on the week here to start the beginning of the year. And I get oftentimes questions from clients and people who are interested in the stock market, investors, et cetera, that kind of are curious about what what your take is, right? When you're a CFP or when you're a registered investment advisor, what's your take on what's happening with stocks and the Federal Reserve interest rates, et cetera? Well, the way that I manage that is really trying to figure out what it is that you're trying to accomplish by investing. So the thing that we need to think about when it comes to stock market returns is that if you're an investor that's in a building wealth phase, meaning you're actively contributing to your 401k plan, to your IRAs, your brokerage accounts, whatever your goals might be, and you're actively contributing to those goals, then a market that has periodic downward shifts or moves to the bottom are actually beneficial times for you as a contributor. One of the things that I encourage you to look up and just read about quickly would be dollar cost averaging. So this is a strategy that really just happens automatically if you have any sort of scheduled deposits that happen in your investment accounts. But basically, when you're setting up a contribution of a set fixed dollar amount, right? Maybe it's a few $100s a month or $1,000 a month, whatever it might be that goes into an investment account. When the stock market is down, you're actually purchasing more shares of the types of companies you want to own, the ETFs, mutual funds, or individual stocks that you want to own at a lower price than you would otherwise be able to buy them. So every time that the market's down 5% or 10%, and you're in this building wealth phase where you're trying to accumulate and grow your wealth over time, that's actually good for you as the investor. It's like going into a store that has something that you really like. And when you walk in, you find out that today they're offering it 10% off their normal price. That's fantastic. Why wouldn't you be excited about that? The reason we're not excited is because we look at a balance as opposed to understanding that negative returns in the short term, markets that are down when we're purchasing shares, actually increases our future prospect, our future potential for positive gains in returns. So whenever you're in a build wealth phase, you really ought to think about downward market trends as an opportunity for you to be excited about saving. You're actually buying more shares of good companies, things that you want to own in your portfolio long term, and that actually increases your forward potential of performance in the future. So it's actually a good thing. Now, it's hard to explain that to somebody when their emotions are tied up in what the markets are doing or what CNBC says or what the news said. You need to kind of turn those things off when it comes to daily fluctuations. I'm not saying you should be ignorant of what's happening in the world or ignorant of what's happening in markets. But unless you're trying to play some sort of technical day trading game or options or something that's requiring you to understand daily fluctuations, which that's a whole nother separate video about why I think that's a terrible strategy for long-term investors. But unless you're in that space, the up and downs that happen on a daily basis don't affect you. Your job is to control the things you can control, manage your expenses, manage how much you're saving, create positive cash flow that allows you to have additional income that can be saved or invested in the future, focusing on your goals, debt management, goal setting, all of those types of things so that you can keep contributing. Now, if you're older and you're someone who's actually in a phase where you're spending down your wealth, you're actually pulling funds, whether it's through required minimum distributions or you just have lifestyle expenses and you need income from your portfolio, then there's a couple different ways to think about down markets. One is to reevaluate and ask yourself, am I really invested in a way that allows me to feel comfortable with the volatility I'm experiencing and still pull money from my accounts? It's possible that your portfolio is too aggressive, so the swings of highs and lows are too vast, and that creates anxiety for you. You want something that's more stable, which obviously means lower future returns, but it doesn't allow you to have quite the roller coaster that you will in a 100% stock portfolio, for example. So one issue might be, again, for these folks that are spending down their assets, you might have a portfolio that's just a little bit too aggressive, and you need to look at managing or monitoring that. The other thing that you might need to think about is how you actually can create dividend yield or interest yield, fixed income, that's going to come and spit out income payments to you from your portfolio. So it's great to have a portfolio that you can say, hey, I want to sell this much, take the cash and go spend it. But what if you had a portfolio that actually had dividend yield? What if you had a portfolio that created or produced income through REITs or fixed income bond exposure? What if you had a portfolio that would actually create its own income that you could use to fund your expenses? Well, that's possible too. And the realization is that when markets go down, when stocks who are issuing dividends go down in price, their dividend yield actually goes up. And so you might have opportunities to lock yourself into individual positions as markets go down that are now paying a higher dividend yield. The dividend that they're paying is higher relative to their stock price than what it was most recently. And so you need to be thinking through other creative ways that you can get income out of your portfolio other than just selling. And as far as kind of just wrapping this up, you never want to be in a position where you're selling under pressure. This goes for both people who are in the wealth building phase and people who are spending down their assets. You never want to be in a position where you have to sell under pressure because of some other variable that isn't connected to the stock market. So for example, people often say, hey, I need a down payment for a house and thinking about investing some of this money. It's like, well, wait a minute. When do you actually need the down payment? Is it within the next year, 2 years, 3 years, 5 years? You should think very carefully about investing those dollars. You never want to be, hey, I need to come to the settlement table and now I have to sell a portfolio that's down 10% or 20% because I was too aggressively invested and I don't have time to make up these losses. I need the money too quickly. You have to think through these variables. So one of the things I do with my clients is have these kinds of conversations, help them understand these three facets of investing. What's their risk tolerance? How much up and down, how high can the roller coaster go and how low can it go before you get, you want to get off the ride? So the volatility, the risk tolerance, I help them understand their time horizon. What's the goal that we're looking at? How far away is that? And what's the likelihood that we're going to be able to accomplish our goals in that given time? And then I also help them understand the complexity of the portfolio, right? So goals, risk tolerance, time horizon. What it is that you're trying to do, what is the actual thing you want to accomplish inside of this portfolio, and how can we allocate the investments in order to help you get to a place that you can achieve those goals, or at least have a reasonable expectation that this portfolio is setting you up for the best opportunity for success. So if those are questions you have, or if those are things that you're kind of thinking through as we look at the stock market and kind of look at where we're at the beginning of the year, the S&P's down about 4.5% so far, first week of February, first or second week of February. If that's kind of where you're at and you have questions about that, I'd encourage you to reach out. Go ahead and shoot me an email, josh@joshuaduvall.com, or you can visit my website, joshuaduvall.com. Thank you so much. I hope you have a great day. Bye-bye.